Hello everyone, welcome to this discussion on the revision test papers for May 25 attempt, and also what ICCA has done is they have released something called as model test papers. Now few things for those of you who are writing in May 25 examination. A month back they had released new study material where they had added about 100 questions. Again, most of those questions were picked up from past RTPs and they are just more for your conceptual practice. If you have done conceptually well, then you don't need to worry about should I solve all the questions once again. Alright, so that is one thing what I wanted to clarify here. If required, just go through them towards your revision when you are revising the syllabus. At that point of time, you can definitely have a look at the questions and answers. There is nothing great to worry about. Okay, and in fact, I'll be releasing videos for each chapter. In any chapter, if you find any difficulty, you can just go to those set of videos and clarify your doubts. That is the first thing. Second thing is what they have come up with model test papers. Now, as far as these model test papers are concerned, they are nothing but they have picked up mock test papers of the past. They have taken some questions from RTPs and also they have picked up the latest November examination paper and they have given it to you as model test paper. So, do we need to solve all of them again? What I would suggest is when you are revising, when you have done a couple of revisions or in the first revision, when you are writing your mock tests, at that point of time, randomly, you can choose one model test paper and solve them. That will help you to get examination confidence. One thing for CA final students, there is no end to how many questions you can practice. Okay, you keep on practicing and again institute may come up with a new type of questions, and we have seen that happening in the previous attempts as well. So the best thing is be conceptually clear, go through as many questions as you can. If you find some question to be tricky, even after revision you struggle to solve that question, and then in that case you can definitely have a look at those questions. Now coming to the RTP discussion, so I have the RTP placed on here. We'll talk about what are the questions, how you should approach. And to begin with RTP, the first one, case scenario number 1. This I would want you to do on your own. I will not be doing it because it's a very simple case scenario. And whenever we talk about a case scenario MCQ, the first thing that we should be doing is go and check what is the requirement of the question. So here the question is asking about indemnification assets and contingent liability. Now this we have understood that if there is a contingent liability and the seller has agreed to compensate you, has agreed to indemnify you, you will recognize an indemnification asset. So to what extent? To the extent of contingent liability. Accordingly, you can solve this MCQs. I will not solve this because otherwise you will not practice. Okay, it's very important. Then the second one, I don't think this would come in the examination. The second one is much more simpler. This is based on your principles of impairment and non-current assets held for sale. If you follow the simple logical approach, you will be able to get the answer. So this also I am not discussing. Now what we will be discussing is accounting for different standards related questions. Here few questions I will be doing it along with you, and for the remaining one, as I tell you, you can practice on your own. The first one on India's 28, investment in associates and joint venture. X Limited acquired a 10% interest in V Limited for rupees 50,000. On 1st of June of 2006 or year 6. The investments in V Limited was accounted for as equity investment not held for trading. So it was not held for trading, for which irrevocable option has been availed for subsequent measurement of financial asset at fair value through other comprehensive income. So they have classified it as not held for trading. So the option that they have used is FV2OCI. All the gains and loss would be accumulated in fair value in other comprehensive income, and that subsequently will not be classified to P&L, right? X Limited recognized an increase in fair value of 30,000 in other comprehensive income for the year ended 31st March of year 7. So 30,000 of gain has been recognized. Purchase for how much? 50,000. Okay. See, here you are not applying equity method yet because you only have 10% interest, right? Then X Limited acquired an additional 25% interest in V Limited for rupees 2 lakhs on 1st of April and achieved significant influence. So got additional 25%, and here is when significant influence was acquired. The fair value of V Limited's net asset was rupees 2,50,000 at June of year 6 and had increased to rupees 4 lakhs at 1st of April. So this June of year 6, what they have said is the original acquisition date. That is not relevant for us. On 1st of April, when this associate relationship is established, the fair value is given to be 4 lakhs. We Limited recorded profits after dividends of rupees 1 lakh between 1st of June and 1st of April. Again, that is what the acquiree has done. Okay, we will not account for it because the increase in net assets and all of those things, that is only relevant when we follow equity method. Here it is not relevant. How should X Limited account for an investment in V Limited on account of piecemeal acquisition when such investment provides X Limited significant influence over V Limited? Pass necessary journal entries for the same. Now here what we need to understand is, first thing, it's a piecemeal acquisition. Now India's 28, when we learned about it, it does not give specific guidance on piecemeal acquisition. So what we can consider is, when we are accounting for this associate relationship, what we can do, like we do in Ind AS 103, what we can do, we can take fair value of existing stake plus new cost, whatever is the cost of new acquisition or the new stake. Means take fair value of this 10% stake, and for the balance 25%, whatever amount we have paid, we can consider that and we can do the accounting. Okay. Now, we have paid 2 lakhs on 1st of April. This becomes my cost for 25%. This is 2 lakhs. And the fair value was 2,50,000 at June 6 for V Limited and had increased to rupees 4 lakhs on 1st of April. Now, why is this fair value given? Fair value of net assets is given for us to calculate whether there is goodwill or whether there is capital reserve. Okay. So, what is the fair value? Fair value on 1st of April is 4 lakhs. So, on that date, when we calculate the goodwill or capital reserve, we will consider 4 lakhs. Right. Now, what do we do with this 10% stake? See, they have not given fair value of 10% stake. Have they given? They have not given. Now, what do we do with this 10% stake? What we can do is, this 2 lakhs, which is paid for 25%, we can assume that that is the fair value, and accordingly we can calculate for 10%. So, what we can do is, fair value of existing stake is equal to 2 lakhs, that is paid for how much? 25%, multiplied by 10%. So, if I do 2 lakhs divided by 25%, 25 4 8, 80,000 becomes the number. So, fair value of existing stake is 80,000, new stake cost is 2 lakhs. So, total amount paid is 2 lakhs 80,000. Total amount paid is 2 lakhs 80,000. Then, what is the fair value of net assets? Fair value of net assets is given to be 4 lakhs. Out of this, our stake, which company is this? X Limited. So, you can say X Limited's share is equal to 35%. So, 4 lakhs multiplied by 35%, 35 to the 70, 140. We paid 280, we got 140. So, our goodwill is 280 minus 140, goodwill becomes 140. Please remember, we will not separately recognize this 240, we will just disclose it as a goodwill component. Alright. So, what is the entry? When we pass the entry, what we need to understand is, investment in associate is at 280. Investment in associate is at 280. This number. Alright. So, we have to bring investment in associate to 280. Then, our original stake. What was our original stake? Original stake was at 50,000, which was increased by 30,000. So, now original stake is 80,000. That 80,000, okay, anyways, this number is also 80,000. So, we have already brought it to 80,000. We have already brought it to 80,000. Have they mentioned that? They said as on 31st March. Okay, they acquired on 1st of April. They acquired on 1st of April, and hence, you know, that number remains the same or becomes the same. But otherwise, also what you should be doing is, if that is directly not given, for 25% what we have paid 2 lakhs, so for 10% it is 80,000, accordingly we can do it. Alright. So, existing stake it has 80,000. So, what we need to do is, we need to debit or create new investment. So, we will say investment in associate, debit 2 lakhs 80,000. Here we are following equity method. To cash, how much did we pay in cash? We paid 2 lakhs in cash. 2. Our existing investment, which we are following fair value through other comprehensive income, that will be de-recognized. 80,000. Then this gain of 30,000 will be transferred from FBT OCI to on the P&L to retained earnings. Alright. So if I have to, so this we have already calculated. Investment to OCI. Investment to OCI, this is for increasing the value of investment, which they have already done. That is what the question mentions, right? The question says that recognized increase in fair value on 31st March, and what they have said, pass necessary journal entry. So they have passed the entry for even increasing the net asset. All right. Then investment 2 lakh 80 to bank 2 lakhs to investment 80,000. Then OCI 30,000 to retain earnings 30,000. All right. So that is how we will do. Coming to the next question, a very good question on Ind AS 109. Okay. On 1st of April, ABC Limited issues a 10-year bond with a par value of rupees 15 lakhs and an annual fixed coupon rate of 8%, which is consistent with market rates for bond with similar characteristics. So 8% is the coupon, and which is consistent with market rates for similar bonds. So similar bonds with similar characteristics. ABC uses secured overnight financing rate. So earlier we used to have LIBOR, now we don't have LIBOR, we have SOFR. LIBOR is discontinued as its benchmark interest rate. So it refers SOFR, that is the market rate, to be 8%. That is the benchmark rate. At the inception, SOFR is 5%. Means 5% is SOFR or the benchmark interest rate. We have issued at 8%, means plus 3%. This 3% is the entity specific component. 3% is the entity specific component. SOFR has decreased to 4.75% at the end of first year. So after 1 year, it has come down to 4.75%. Means what? If I assume my existing creditworthiness, 4.75% plus 3% is 7.75%. The fair value of the bond is 15,38,110. This value is consistent with an interest rate of 7.6%. So at the end of the first year, they have considered an interest rate of 7.6%. Whereas the interest rate should have been 7.75%. Sir, why did they consider 7.6%? Maybe their creditworthiness has changed. Their creditworthiness has improved, and this 3% has also reduced correspondingly. The remaining cash flow on the bond are 1,20,000 per year for 9 years and 15 lakhs at the end of the 9th year. These cash flows discounted at 7.6% equals 1538. So what they have done is, your cash flow, how will you get the cash flow? See, 15 lakhs into 8%, 1,20,000. It was a 10-year bond. Now it is a 9-year bond. So for 9-year bonds, 1,20,000 for 9 years. 1,20,000 for 9 years, you get some number. That and the principal, if you discount at 7.6, you get 1538,110, which is the number given here. ABC assumes a flat yield curve that all changes in interest rates result from a parallel shift in the yield curve, and that changes in SOFR are the only relevant changes in the market condition. So what they're saying, whatever is changing in SOFR, that itself, SOFR is the only relevant change in market condition. Means whatever market rates, wherever market rates have changed, the SOFR indicates the rate changes. That is one thing. Means if SOFR has changed from 5% to 4.75, that 0.25% shift represents all the changes that has happened in market. Which also means any other change is related to the entity specific condition. That's the first thing. Now they also have introduced this term flat yield curve. This you would understand in AFM as well, that the curve, the yield curve shifting is assumed to be flat. So the near term, the long term rates, if you plot the yield, they appear to be a flat curve. Alright. Now here, what is important? What is the amount to be transferred to the OCI at the end of year 1? Following discount rates may be considered for this. Now, what is the amount to be transferred to OCI? Whatever is the change that happens because of the entity specific condition, that amount has to be transferred to OCI. This you have understood. Whenever there are fair value changes, which is because of the instrument specific risk, That is what we have to transfer to OCI. This we have understood. Now, when we consider the discounting factors, see, discounting factors at 7.75% means assuming my instrument specific credit risk has not changed, my rate will be 7.75%. So I have to discount the interest, which is 1,20,000, and the principal, which is 15 lakhs, with 7.75%. Now at the end of year 1, how many years are left? At the end of year 1, you are left with 9 years. So at the end of year 9, the present value is 51.1 paise, means for 1 rupee it is 51.1 paise. That means if it is 1 payable, then it is only 51.1. That means 0.511 rupee is what I can consider. Then for year 1 to 9, cumulative discounting factor is 6.312. So 120 multiplied by 6.312, 15 lakhs multiplied by 51.1, that gives you the present value of the future cash flows at 7.75% or the benchmark interest rate. So what is the present value because of that? What is the present value because of that? 15 lakhs into 0.511 plus 120 into 6.312, we get 1523,670. This versus the fair value that is given 1538,110. That is the fair value of the instrument. So the difference between these two will be recorded in OCI, that is 14,440. Alright, moving to the next one. On 1st April of year 1, A Limited issued 10% convertible debenture with a face value of 1,000 maturing on 31st of March, that is after 10 years. Debentures is convertible into equity share of A Limited at a conversion price of Rs 25 per share. Interest is payable half yearly in cash. Now here, interest is payable half yearly. At the date of issue, A Limited could have issued non-convertible debt with a 10-year term bearing a coupon interest rate of 11%. So if you had issued non-convertible debt, you would have issued at 11%. So 11% becomes our relevant discounting factor. On 1st January, the convertible debenture has a fair value of 1700 on 1st of January of year 6. The convertible debenture. A Limited makes a tender offer to the holder of the debenture to repurchase the debenture for Rs 1700. Means you are repurchasing, which the holder accepts. On the date of repurchase, A Limited would have issued a non-convertible debt with a 5-year term bearing a coupon interest rate of 8%. How does A Limited account for repurchase? So similar things we have seen. Only thing here that is different is the interest that is payable is half yearly. If interest is payable half yearly, then what do? When we discount it, we will discount it at 11%, considering half yearly payments. Alright. So our interest is 10% with a face value of 1000, means 1000 into 10% if I do, I get 100, but every 6 months I will pay only 50. Now you can take your calculators and you can calculate the discounting factor 1 divided by what? Now the relevant rate is 0.11%, but we will take 5.5% for calculation purpose. So if I just do it, you can also do it on a calculator. Typically nowadays they have started giving it in the examination because of so many confusions what students got. So term is 20 years, rate is 5.5%, and the present value of this, if I calculate 5.5% for 20 terms, payment of 1 is 11.9504. Okay, so if you are doing calculator, you have to do it 20 times. 1 divided by, please be careful, 1 divided by 1.055. 1 divided by 1.055, do it 20 times and grand total. So we got how much? I got 11.95. I have used Excel. You can use your calculator. This is the present value annuity factor. Okay, then at the end of 10 years, you will repay how much? 1000. Now this 1000 also, when you discount it, you will discount it at 5.5% for 20 terms. You will discount it as 5.5% for 20 terms. Okay, so that is another thing you have to keep in mind, that it will not be, don't do it for 10 periods, you have to do it for 20 periods. So that number what I get is 0.342. Okay, so that gives me the present value. So Present value of 20 half yearly payments 598, which is rupees 50 into 11.95. Present value of 1000 due in 10 years discounted at 11% is 342. So 598 plus 342, what we get? 8 plus 2 is 0, 9 plus 4 is 13 plus 1 14, 940. This is the liability component and this is the equity component. 60 is the equity component. This is the initial accounting. Now, when you repurchase, what has happened? When they have repurchased at the end of 5 years. At the end of 5 years. And at the end of 5 years, what they are saying, the relevant discount rate is 8%. The relevant discount rate is 8%. Now, what is the purpose of giving this relevant discount rate? See, by using this relevant discount rate of 8%, we can calculate what is the fair value of the liability. What is the fair value of the liability? So, how do we calculate fair value of liability for 5 years remaining payment? So, if you discount at 8%, so let me just the number, how much will the factor be for 10 periods and 8%, that is 4%, discounting at 4%, present value of 4% for 10 periods at, if I discount it, I get 8.11. I get 8.11. This is the present value annuity factor. You can also do it. So, whatever I pay for 5 years at 8%, the present value annuity factor is 8.11. So, 50 multiplied by 8.11, if I do 50 multiplied by 8.11, I get 405.5. They have rounded up to 406. This is the present value of the liability of interest component. Then, I also have to pay them this 1000 at 8%. The present value of that is 676. So, what is the total present value of the liability? 1082. This is fair value of liability at end of 5 years, considering 8% discount rate. What is my carrying amount? See, my carrying amount is present value of remaining interest plus principal for 5 years discounted at 11%. If I do that, I get the carrying value. Or if you want, you can prepare the amortization schedule, but that is a longer process. Alright. So present value becomes 377 and 585. So for this also at 11%, for 5 years, calculate the present value factor, which is 5.5% for 10 periods. So this is 377, 585. So the present value of or carrying amount of liability is 962, equity is 16. The total value is 1022. The fair value 1082 is liabilities fair value, 1700 is the fair value of the convertible debentures. So the balance 618 represents what? 618 represents the equity component fair value. Alright. Now we have paid 1700 and bought back. Means what? Against 962 we have paid 1082. 962 is the carrying amount. We have paid 1082. There is a loss of 120. Again 60 we have paid 618, we have paid 558 extra. So the accounting entry will be for liability component, debit the carrying amount, debit the P&L 1082, and for equity, debit the reserves and surplus or other equity. We have paid cash of 618. It looked like 61 and 8. We have paid 618, again 60. So this you will debit equity and debit reserves and surplus for settling the equity component, and you will credit cash, that is 618, whatever you have paid. Alright. So that is a very simple and straightforward question. Nothing much complicated. Alright. Then business combination. This one is straightforward and a simpler question, and this you can directly do it on your own. There is nothing complicated. Only thing is that initially there is 30% of XYZ, so where you have done associate accounting. While doing associate accounting, we have recognized share of exchange difference in OCI and share of revaluation reserves of PPE in OCI. Now this 150 that we have recognized, this 100 from OCI, this will be transferred to P&L subsequently when we de-recognize the associate. That is the first thing. But this revaluation reserve that is there in OCI will continue to remain in OCI. This we will not transfer to the P&L. Okay, that is one thing. And fair value is now 9,000. Fair value is 9,000, and here you see they have bought at 8,000. They have recognized 700, 150. So this is 850. Carrying amount is 8,850. Fair value is 9,000. So 150 is another gain that you need to recognize. So this 150 of gain and this 100 of gain, 250 will go to P&L and this 50 will go to OCI. Okay, that is the only thing. Goodwill and all you can calculate. It is simple thing only. So if you see here, gain is 250. How? 100 of exchange difference that will be recognized in P&L when we dispose of the associate, and 150 is the gain because of change in fair value of investment. Because of change in fair value of investment. Alright. So this you can do it. That's the only one thing you need to keep in mind here. Then business combination, they have given book values, tax basis and fair values. They have asked us to calculate deferred tax asset. This similar questions we have done. You can practice it. There is nothing new for you to be worried about. You can do it on your own. Then India's 21. P Limited incorporated in India owns 70% interest in foreign entity S Limited. P has INR as its functional currency, S as US dollar. P Limited sells entire investment in S Limited for 3,200,000. The following information is provided. Now, when you have sold entire investment for 3,200,000, you will debit cash. Then, what we will do? We will de-recognize NCI, the net asset that is attributable to NCI. Then the 630 of our share of whatever is there in the foreign currency translation reserve, that will now be recognized in P&L. Okay, so you debit cash and bank by 3,200, you debit NCI by 1,200. Sir, why we are debiting NCI? Because we are de-recognizing. Then OCI, whatever was the balance 630, that OCI will be transferred to P&L. Net assets will recognize at 4,000, the entire net assets, and we will calculate the profit on disposal. Okay, this again, you can have a look at it and do it on your own as a practice. So if you see profit on disposal, we have got 3,200 of cash, we have net assets of 4,000 and minus 1,200 of NCI, so we have 2,800, right? So gain is 400 on this, and this OCI, whatever we would have recognized earlier in OCI, that we will transfer to P&L. So OCI debit and P&L debit is in our books. Sir, what about NCI OCI? NCI ka OCI we don't recognize. We consider them as a part of the net assets only, and hence it will remain as it is. Then one on Ind-AS 2 inventories, straightforward. You can easily handle this. Then statement of cash flows. This is a simple question. Here there is a technical issue in the question which I want all of you to have a look at it. I don't know how many of you could figure that out. The opening balance sheet of 1st April of year 6 of an Indian company which accounts for its transaction in INR consists cash of rupees 1 lakh, share capital of rupees 1 lakh. The company borrows a long-term loan on 30th September of 2200 when the rate of exchange is 87. So what we will do, 2200 into 87, that is the value at which we will recognize the liability initially. So 2200 into 800, if I do, sorry, not 800, 87. 2200 into 87, I get 191,400. This is the original recognition. There are no other transactions. The exchange rate on the balance sheet date as on 31st March is 85. So if it is 85, 2200 multiplied by 85. 2200 multiplied by 85, I get 187. So this becomes 187. I will recognize the liability at 187. Now 187 minus 191400 that I have recognized. 4400 is my gain. This gain will be recognized in P&L, but somehow institute what they have done is they have transferred that gain in foreign currency translation reserve. This is incorrect. I have borrowed money. It is a foreign currency monetary item that has to be recorded in P&L. Okay. How the foreign exchange difference arising from unsettled transaction will reflect in the statement of cash flows. So now here they are asking, how will it be reflected in the cash flows? Now how will we reflect that in the cash flows? Very simple. There is, what is the cash flow? One is we have got cash flow from financing activity. We have got cash flow from financing activity. Then we have a gain that we have recognized in the P&L. We have a gain that we have recognized in the P&L. But is that a realized gain? That is not a realized gain. So what will happen is your P&L will show a balance of 4,400. P&L will show a balance of 4,400. Now out of that 4,400, have we received anything? We have not received anything. Okay, because it is not yet realized. So whatever is the foreign exchange gain, we will adjust it, we will reduce it by 4,400. So our operating cash flow becomes 0. Then inflow from financing activity. How much did we get? We got inflow from financing activity. How much did we get? We got 191400. So proceeds from, because we have taken a loan, 191400. This is one thing that will come up. Okay, then what is the closing cash equivalent? 2914. So 1914 is the inflow. Opening cash is 100,000 or 1 lakh. You get 291400 as the closing cash and cash equivalent. Please remember, there are no foreign currency cash in hand. Here it is not foreign currency cash in hand. It is Indian cash only. We have converted, and hence we are reporting. So there is no reconciliation of foreign currency cash in hand. Okay. Then this one slightly complicated. They have used most likely generative AI to create this kind of complicated question. So the next question that we have is on related party. Mrs. Y fathers own 100% of shares in A Limited. Whenever there is a related party question, I would strongly suggest, draw it in a diagram format so that you don't miss out things. So what happened? Mr. Y's father owns 100% of A. So you have Y's father. They own 100% of what? A. Okay. Mr. Y and Mrs. Y own 100% of the shares in B Limited. So Y's father is there. You have Mr. Y, and also you have spouse of Mr. Y. They own what? They own 100% of B. They own 100% of B. Okay. Mrs. Z, who is Mrs. Y's sister. Now here becomes slightly complicated. So sometimes I feel it's more of a logical reasoning examination. You have Mrs. Y. Mrs. Y has a sister. Mrs. Y has a sister. What does Mrs. Y do? Mrs. Z. So sister's name is Miss Z. Provides bookkeeping services from time to time to B Limited. Okay, so they provide time to time to B Limited. What services? Bookkeeping services. Okay. Mrs. Z is not an employee of B Limited. So they're not an employee, they're directly providing. However, Mrs. Z is not an employee. A Limited has increased its loan of 1,50,000 to B to rupees 2 lakhs during the year, for which A Limited charges below market. So A has given some loan, the loan has been increased, and there is a below market rate. They have charged below market interest rate. State whether Mr. Y's father and Mrs. Y's sister are related party of B Limited. Now A is here, B is here, Mr. Y and Mrs. Y are here. Can Mr. Y's father be considered to be related to A Limited? Now what do we know? They are A Limited if they are members of a close family. Okay, you have to look at the substance. Now if Mr. Y's father can influence the decisions of Mr. Y, which most likely can happen because there is a father-son relationship. If they can influence, then Miss Y's father would become a related party of B. can become a related party of B because they are a part of close family member. That is one. Then what disclosure is to be made in the financial statements of both A Limited and B Limited with respect to loan given by A Limited to B Limited? Now, they have given loan. What has to be disclosed? First is what is the amount of transaction. The amount of transaction is that they have increased the loan to 2 lakhs. So that has to be disclosed. Then we also need to disclose the fact that it has been made in, whatever they have said. They have said whatever is the rate is charged, the rate charged is less, and that has to be disclosed because it is a below market rate. That fact has to be disclosed. Then you should disclose what is the amount outstanding between both the parties, that is 2 lakhs in this case. And then you also need to disclose if any amounts have been written off, that we can have a look at it. Then whether B Limited is required to disclose the dealings with the sister of Mrs. Y in its financial statement. Now, if you have a sister of Mrs. Y, can the sister of Mrs. Y, that is Mrs. Z, can they have an influence over Mr. Y and Mrs. Y? Typically, if yes, they have that kind of influence, then disclosure is required. If the influence doesn't exist, then disclosure is not required. Now, because see, you have to look at whether they are a part of a close family member. After marriage, the relationship can be different. Mrs. Y may not be dependent on Mrs. Z, and hence that relationship has to be examined from an angle that now they have actually, Mrs. Y is already married, and the sister may not be able to influence the decision. If they are able to influence the decision, then definitely you need to make the disclosure. Okay, so that is about the discussion of RTP for May 24. The questions which I have said you can practice on your own. Please practice on your own. Remaining questions also I have given an overview. I want you to practice. Put pen on paper, write down the answers so that you get confidence for the examination. Thank you.